While you're working hard for your paycheck, the average financial path is quietly guaranteeing that you will run out of money long before you run out of time. Today, we are breaking down the mathematical nightmare of the average trap and why your current retirement strategy might be a lie. Most people spend their entire lives following a script that was written for a world that no longer exists. They go to school, get a decent job, and aim to be average. They save a little bit here and there, contribute just enough to their accounts to feel safe, and assume that if they do what everyone else is doing, they will end up just fine. But here is the brutal reality. Being average in today's economy is a one-way ticket to financial disaster. If you look at the statistics for the average person approaching retirement age in 2026, the numbers are not just disappointing. They are terrifying. We are talking about individuals who have worked for 40 years only to realize they can't even afford to maintain their basic lifestyle for more than 5 years without government assistance. This is the average trap. It is a comfortable, slow-moving slide into poverty that feels safe while you're in it because everyone else is doing the same thing. You see your neighbors buying cars they can't afford. You see your friends taking vacations on credit, and you think, if they are doing it, I must be okay. But the math doesn't care about your social standing or your comfort level. The math is cold, hard, and unforgiving. When you look at the gap between what people think they need and what they actually have, the deficit is staggering. The reason 90% of people will retire broke isn't because they didn't work hard. It's because they followed a flawed blueprint that prioritizes immediate consumption over long-term survival. They focused on the visible signs of wealth today while ignoring the invisible erosion of their future purchasing power. In this part, we are peeling back the curtain on the first layer of this trap, the myth of the safe savings rate. Most financial advisors tell you to save 10%, but in an era of high inflation and stagnant wages, 10% is no longer a safety net. It is a hole in your pocket. By the time you realize the math doesn't add up, it's often too late to change course. You are being conditioned to accept a lifestyle of just enough, but just enough quickly turns into not nearly enough when an emergency hits or when the market takes a dip. We have to stop looking at what the crowd is doing and start looking at the data, because the crowd is walking straight off a financial cliff. If you want to survive, you have to break the script. The most dangerous aspect of the average trap is not what you spend, but what you lose to the silent, invisible tax that devalues every single dollar you've ever earned. Inflation is often discussed in the news as a minor percentage, a small fluctuation in the price of eggs or gas. But for the retiree, it is a predatory force that eats the very foundation of their freedom. When the average person looks at their bank account and sees a specific number, they feel a sense of security, believing that the number represents a fixed amount of purchasing power. However, that number is a moving target. If you are planning to retire 10, 20, or 30 years from now, $1 million will not buy you $1 million worth of lifestyle. It might barely cover the basics of a modest apartment and healthcare. This is where the 90% fail. They calculate their future needs based on today's prices. They don't account for the fact that the cost of living historically doubles every 20 years, and in recent times, that pace has accelerated significantly. While you are sitting back thinking your average savings plan is on track, the government is printing more currency, and the global supply chain is shifting, effectively shrinking the value of your nest egg while you sleep. Most people assume that putting money in a standard savings account or a low-interest bond is safe because the balance doesn't go down. But in real terms, if your money isn't growing faster than the rate of inflation plus your tax liability, you are actually losing money every single day. This is the safety paradox. By trying to avoid the volatility of the stock market or the risks of investing, the average person takes on the guaranteed risk of total devaluation. They trade the possibility of temporary market dips for the certainty of long-term poverty. Think about it. If you save $1,000 today and inflation is just 4%, that money loses half its value in less than 18 years. Now imagine trying to survive a 30-year retirement on a fixed sum that is losing value every hour. The average person ignores this because it's a slow burn. It doesn't hurt today, so they don't fix it. They continue to contribute to accounts that offer 1% or 2% returns, while the real cost of living is climbing at 6% or 7%. This gap is the graveyard of retirement dreams. To escape the 90%, you must stop thinking about nominal dollars. the number on the screen, and start thinking about real wealth, what that money can actually buy. If your strategy doesn't include a hedge against the intentional debasement of currency, you aren't saving for retirement. You are just watching your hard work evaporate into thin air. We have to understand that the system is designed to reward debtors and punish savers. And if you stay an average saver, you are the one paying the price for everyone else's spending. This realization is the first step toward building a wall around your future that the government and the banks can't climb over. Now that we've identified the silent killer, we have to look at the second pillar of the trap, the myth of the steady career path and the danger of relying on a single source of income that can be turned off at any moment by a corporate board. The third pillar of the average trap is perhaps the most culturally ingrained, the dangerous reliance on a single, linear career path as the sole provider for your future. For decades, the gold standard of financial security was to find a stable company, climb the ladder for 40 years, and trust that your loyalty would be rewarded with a comfortable exit. But in 2026, that average career path is no longer a ladder, it is a tightrope. Most people are one corporate restructuring, one AI breakthrough, or one health crisis away from total financial collapse. The 90% who will retire broke are almost exclusively individuals who traded their most valuable asset, time, for a single paycheck, without ever building a system that works independently of their physical presence. When you have only one source of income, you are effectively a servant to that source. You cannot negotiate from a position of power, you cannot pivot when the industry changes, and you certainly cannot save enough to outpace the rising costs we discussed in Part 2. The math simply doesn't work when your income is capped by the number of hours you can physically work. The average person spends their peak earning years trying to increase their salary just to keep up with their lifestyle creep, buying bigger houses and faster cars the moment they get a raise. This creates a golden cage where, despite earning more, their net worth remains stagnant because their expenses rise in lockstep with their paycheck. They become high-income poor. They look wealthy on Instagram, but their bank accounts are empty shells. This fragility is exposed the moment the paycheck stops. Without the constant injection of cash from a 9 to 5, the average person's lifestyle crumbles within 3 to 6 months. They have spent 40 years building someone else's empire while leaving their own land completely barren. To break out of the 90%, you must shift your mindset from being a consumer of income to a builder of assets. Assets are things that put money in your pocket whether you wake up or not. Whether it's stocks, real estate, digital products, or a side business, you need a secondary engine that generates momentum. The average person views a side hustle or investing as risky, yet they find it perfectly safe to put 100% of their financial survival in the hands of a boss who doesn't know their middle name. This is a total inversion of logic. True security doesn't come from a high salary. It comes from the diversity of your cash flow. If you lose one stream, you should have 3 more still flowing. The 90% fail because they put all their eggs in a basket they don't even own. They focus on working for money rather than making money work for them. This leads us to the next critical mistake, the misunderstanding of debt. Most people see debt as a tool to buy things they want now, but the wealthy see it as a tool to buy things that make more money. By the time the average person realizes they've used their credit to buy liabilities instead of assets, the interest has already locked them into a cycle of permanent labor. You must realize that your job is a starting point, not the destination. If you don't find a way to make money while you sleep, you will work until you die, and that is the ultimate endgame for the average person. Now, we have to talk about the debt anchor and how it drags even the highest earners back down to the bottom. The fourth reason why the average person fails is the misuse of leverage, or what most of us simply call debt. In our modern society, debt has been rebranded as purchasing power, but in reality, it is an anchor that keeps you tethered to a life of mandatory labor. The 90% of people who will retire broke are usually those who spent their youth borrowing from their future selves to fund a lifestyle they hadn't yet earned. They take on massive student loans, 30-year mortgages, and high-interest credit card debt, all under the guise of building a life. What they are actually doing is selling their future freedom for pennies on the dollar. Every time you take on consumer debt, you are making a bet that your future self will be willing and able to work hard enough to pay it back plus interest. You are effectively locking yourself into a cage where you cannot afford to take risks, you cannot afford to quit a toxic job, and you certainly cannot afford to invest. While the wealthy use debt to acquire cash-flowing assets, like real estate that pays for itself, the average person uses debt to acquire depreciating liabilities. They buy the new SUV that loses 20% of its value the moment it leaves the lot, and they pay for it with money they haven't made yet, at an interest rate that doubles the final cost. This is a mathematical trap designed to keep the working class in a state of permanent payment. You become a collection agent for the bank, working 40 hours a week just to pass your paycheck through your hands and into theirs. By the time the average person pays off their lifestyle debt in their 50s or 60s, they have missed the most critical window for compound interest to work its magic. They have spent the most productive decades of their lives paying for the past instead of investing in the future. To escape the 90%, you must view debt as a dangerous chemical. It can power an engine if used perfectly, but it will burn your house down if handled carelessly. Most people are currently standing in a burning house, wondering why it feels so hot. They think that as long as they can make the minimum payment, they are doing okay. But the minimum payment is the bank's way of ensuring you stay a customer for life. If you want to retire with more than the average person, you have to stop being a renter of your own life. You must break the cycle of monthly installments and start reclaiming your income. Only when your income is truly yours can you begin to build a foundation that won't wash away in the next storm. This leads us to the fifth pillar, the devastating cost of waiting for the right time and the illusion of the late start recovery. The fifth reason why 90% of people retire broke is a psychological trap called the tomorrow myth. Most people believe that they will have more money, more time, and more clarity in the future to start getting serious about their finances. They tell themselves, I'll start investing when I get that promotion, or I'll save once the kids are out of school. This delay is the most expensive mistake you can ever make because of the lost power of compound interest. In the world of wealth, time is a much more powerful multiplier than the amount of money you actually contribute. The average person waits until their 40s or 50s to start catching up, but by then, the math is working against them. To reach this same retirement goal as someone who started in their 20s, a person starting in their 40s might have to save 5 or 10 times as much every month just to break even. This creates a state of permanent financial stress where you are constantly running a race you can't win. The average trap convinces you that you have plenty of time, while in reality, every year of hesitation is effectively a massive tax on your future self. The 90% fail because they prioritize the comfort of today over the security of tomorrow. They assume that a big break or a lucky strike will save them later on, so they don't bother building the small, boring habits that actually create millionaires. They wait for the perfect market conditions, the perfect job, or the perfect economy, not realizing that the right time never actually arrives. By the time they wake up to the reality of their situation, they are forced to take extreme risks with their remaining savings just to survive, which often leads to even greater losses. To escape this fate, you must realize that the cost of waiting is higher than the risk of starting. You don't need a lot of money to start, but you do need a lot of time. If you keep pushing your financial responsibilities into the future, you are essentially gambling with your old age. The average person treats their future like a stranger's problem, but eventually, you will become that stranger, and you will have to live with the consequences of the decisions you are making or not making right now. The sixth pillar of the average trap is the psychological pressure to maintain a lifestyle that matches those around you. We live in an era of performative wealth, where social media and cultural norms dictate that success must be visible to be real. The average person is caught in a perpetual loop of spending money they haven't earned to buy things they don't need to impress people they don't even like. This is the comparison curse, and it is the fastest way to ensure you stay broke for life. When you see a neighbor with a brand new luxury car or a friend posting photos from an expensive resort, your brain naturally triggers a sense of inadequacy. To solve this feeling, the 90% use their future retirement funds to upgrade their current reality. They justify these purchases by saying, I deserve this, or everyone else has won. What they don't realize is that most of the people they are trying to keep up with are also drowning in debt and have zero net worth. It is a race to the bottom where the winner is simply the one who goes bankrupt last. The average person views their income as a tool for consumption, while the wealthy view their income as a tool for production. If you spend your peak earning years chasing the latest trends and upgrading your lifestyle every time you get a raise, you are effectively trading your freedom for status symbols that will be obsolete in 3 years. This social pressure creates a lifestyle inflation that is almost impossible to reverse. Once you get used to the big house and the fancy dinners, cutting back feels like a failure, so you keep working longer and harder just to maintain a facade. To break out of the 90%, you must develop financial stoicism. You have to be okay with looking average or even poor in the short term so that you can become truly wealthy in the long term. True wealth is silent. It is the money in the bank and the assets in your portfolio that give you the power to say no to a job you hate. If you are constantly worried about what others think of your car or your clothes, you are giving them control over your bank account. The average person retires broke because they spent their life's energy maintaining an image instead of building a foundation. The final reason why 90% of people retire broke is that they lack a definitive exit strategy. Most people spend more time planning a 2-week vacation than they do planning a 30-year retirement. They hope that things will just work out, but hope is not a financial strategy. The 90% fail because they remain passive participants in their own lives, reacting to bills and emergencies rather than proactively building a fortress. If you want to escape the average trap, you must move from a mindset of survival to a mindset of mastery. The first step in your exit strategy is to kill the average identity. Stop doing what everyone else is doing. If the crowd is spending, you should be saving. If the crowd is fearful of the market, you should be looking for opportunities. You must establish a freedom number, the exact amount of passive income you need to cover your expenses, and make that your North Star. Every financial decision you make from this moment on should be filtered through one question. Does this move me closer to my freedom number or further away? Secondly, you must automate your wealth. The average person relies on willpower to save, but willpower is a finite resource. By the end of the month, there's usually nothing left to save. You must pay yourself first by setting up automatic transfers to your investment accounts the moment your paycheck hits. This removes the temptation to spend and ensures that your future is funded before your current desires are met. You have to treat your investments like a non-negotiable bill that must be paid every single month. Finally, you must invest in your greatest asset, your mind. The 90% stop learning the moment they leave school. They become stagnant in their skills, making them vulnerable to economic shifts. To stay ahead, you must constantly increase your earning capacity by learning new high-value skills that the market rewards. Whether it's understanding new technologies, mastering sales, or learning the intricacies of real estate, your knowledge is the only thing that can't be inflated away or stolen by a bank. The choice is yours. You can continue to follow the average path, which leads to a life of quiet desperation and financial struggle, or you can take the difficult road today to enjoy a life that 90% of people can only dream of. The average trap is wide open, but you now have the map to walk right past it. Don't let your 40 years of hard work result in a not good retirement. Start building your blueprint today, because the clock is ticking and the math doesn't wait for anyone. This is your life. Take back control.